What if the biggest threat to your wealth isn't the market, but the tax bill you didn't plan for and the creditor you didn't see coming? Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan. And if you're a business owner focused on keeping more of what you earn and building real long-term wealth, you're in the right place. Today, I'm joined by a peer, Michael Moffa, founder and president of Prosperity Tax Advisors and Prosperity Wealth Advisors. Michael is a nationally recognized financial strategist, tax planning expert, and fiduciary advisor with nearly 2 decades of experience helping business owners and high net worth families implement proactive tax strategy, investment management, and integrated wealth planning. He's been featured in Forbes, the Wall Street Journal, and he's known for his forward-thinking approach to financial planning. In this episode, we break down what it really means to stop playing defense with your finances and start building a proactive plan. We talk about how business owners can approach taxes strategically before year end, how investment decisions and tax strategies should work together, and why having the right advisory team can make or break your wealth building future. Stick with us until the end because Michael shares insights that can completely change how you evaluate your own asset protection and financial strategy. And if you want to dive deeper into tax strategy and wealth building tools, be sure to visit us at vitalwealth.com/resources. That's vitalwealth.com/resources. where we've built a vault of resources designed specifically for entrepreneurs who want to save more in taxes and grow their wealth faster. Also, if you enjoy the show, please take a moment to leave a review. It helps us reach more business owners who need to hear these conversations. All right, let's jump into today's episode with Michael Moffa. I'm excited about our conversation today. We've got Michael Moffa here from Prosperity Wealth Advisors. This is going to be a lot of fun. They do a lot of great work helping entrepreneurs and high income earners pay less tax. So Michael, thank you so much for joining us.
Well, thank you, Pat, for having me on.
Yeah, this is going to be fun. So I think about the entrepreneur and they generally have some problems. They get this fragmented financial advice. They've got their CPA maybe telling them one thing, financial advisor, attorney, insurance providers, and there's just not this integrated and coordinated planning. And at the end of the day, nobody is really doing tax strategy. It's very tax efficient. We've got misaligned investment strategies just because, somebody doesn't pay any attention to the tax side. And so they might be driving forward, doing great things from a return point of view, but then we're giving lots of it to the IRS. And then we're often reactive instead of proactive on the planning side. I think of so many CPAs. We had one client that we were doing some tax planning for at the end of the year. And the last week and a half, their CPA was just out of the office. It's like, yeah, this is when the tax planning needs to sort of be wrapped up. We got to get things across the finish line before the end of the year. And so, when we think about CPA, they're looking in the rearview mirror trying to get things done. And I'm overgeneralizing there, but that's generally where we see things. And then internally, there's just this anxiety. We just look at the complexity that starts to happen with somebody that's growing an enterprise. And it's like, man, there's just all this weight on me to try to figure it all out myself. And there's just concern about, man, is this thing going to fall down? Am I going to lose what I've built? And just decision fatigue. They got so many decisions that they need to make in the business. And then when you start thinking about all the financial decisions, it just becomes a lot. And then lastly, we think about the philosophical problems. Success should create freedom, not this financial confusion and more obligations. And so entrepreneurs deserve clarity and alignment, not necessarily chaos. So I'm looking forward to getting into how you and your team help entrepreneurs solve all of those problems.
Absolutely, man. I can't wait. So you are almost 100% correct on a lot of what you just mentioned in regards to individuals and entrepreneurs and their existing traditional CPA team, right? Mm-hmm. It's not that the CPA is not aware, and some maybe aren't, but it's not that they don't do tax planning because they just wake up one morning and have a decision like, hey, I'm not going to do tax planning for my clients. The issue and the challenge that a lot of traditional CPA firms have is that they are specialized in compliance and financial auditing, right? And if you look at most of the statistics that are out there being brought, almost 98% of the time, a traditional CPA firm, which is typically a CPA or an enrolled agent, EA, and some staff, right? For majority of the time, they're doing just compliance. And compliance is accounting, bookkeeping, tax prep, return,
Yep.
for those clients, right? And a lot of that time is really in the beginning parts of the year, like now.
Hmm.
Right? So we're in February, so you have to gather up all your documents, all your 1099s, your K1s, and then you meet with your accountant. Now, keep in mind, the year is already done, right? So
Right.
we're already past December 31. We're in the next year, and you're looking back and trying to say, what can I do before either I take an extension or I have to cut an additional check to the IRS in a couple of months?
Yep.
Now, a lot of times with these CPA firms is they're just bogged down with hundreds, if not thousands of clients.
Yep.
So as you can imagine, there is no space in their calendar to do tax planning
Yep.
proactively, right? And some do. Now, I'm not discounting a lot of them, but very, very small do.
Hmm.
So
Yeah.
that's the challenge they have, right?
Yep.
They don't have a lot of staff to handle the thousands of clients that they're doing, the hours that they're putting in from looking at the returns and then plugging in the data in the accounting software.
Yep.
And then after obviously April 15th, right? A lot of the firms tend to take a little bit of break,
Yep.
right? And beginning from May to June, and then they come back towards middle of the summer to work
Yep.
on the extensions. That carries them through October. And then at that point, they're really tired. They take some
Hmm.
vacation. They got the holidays,
Yeah.
and the year is done, right?
Yeah.
So what we do differently is we are tax advisory consultants, right? And so what
Hmm.
all we do day in and day out is tax planning.
Yeah.
So we could come in coordinated with your existing CPA. We could work with them. I'll tell you that a lot of times that creates a little confrontation, but that's
Yep.
okay, right?
Yep.
And then the other thing that makes our firm a little different, Pat, is that I am a private wealth advisor by nature for the last 25 years.
Hmm.
So when I created Prosperity Tax Advisors, I created it with the thought process of having our staff, our CPAs are also CFPs, they're also EAs, enrolled
Hmm.
agents. They're also certified exit planning advisors, right? And so I make sure that the team I build through Prosperity Tax Advisors has the subject matter expertise in all areas of tax, wealth, and business.
Yeah.
Why? Because not if we're just focusing on tax planning for the entrepreneur. Well, I mean, a lot of entrepreneurs are business owners, right? At some
Yep.
point in the future, they got to sell that business.
Hmm.
So a certified exit planning advisor, a CPA, right, is ones who go in first into the business, reestablish that the order of the business, and then make sure things are running smoothly. You have employee handbooks done, processes, procedures, workflows done, right? Making sure the business, the EBITDA, all of that looks good. And then we try and raise that multiple upon that exit. So
Hmm.
again, having conversations from a tax perspective, we already know in that field what to look for, right? So
Yeah.
that's what makes our firm mostly unique is that we're not just a CPA and staff.
Hmm.
We are qualified specialists in all areas, right, to help that client make thoughtful advice.
Yeah, we've got so many things we need to talk about here. This is great. I think one thing you hit on that is so important is just the CPA business model.
Yeah.
And we beat up a little bit on CPAs in the beginning, but their business model is just not designed to do the strategy. And unfortunately, oftentimes we hear CPAs promise that they'll do strategy. Yep, we'll help you bring your tax bill down. But really, at the end of the day, they're just doing the compliance. And you outlined perfectly why they can't do the strategy. They have thousands of clients, and their annual rhythm of all the filings, they're just so busy throughout the year that they can't stay on top of what the entrepreneur has going on. And that leads me to the second piece that you were talking about is you've built a team around having people that understand the entrepreneur. They understand the rhythm of their business and how things work. And so, I'm guessing, and I know you guys do this, is you're looking ahead going, okay, let's forecast how much money you're going to be making this year. Let's forecast the tax liability, and let's forecast a plan to solve that problem, right? And so I think that's such a crucial part of this whole process is being plugged into the entrepreneur's financial life in every aspect, right? Like I got to know your free cash flow. I got to know how the business is going. I need to know the rhythm of the cash flow out of the business. Like we see some clients that have this nice monthly recurring revenue, just kind of trends up and to the right. That's awesome. We also have clients that have these seasonal businesses that have huge spikes at different times of year. And then they are losing money, month over month, and other times of the year. Now, annually, they're making healthy money, but you have to plan for those things. And if you forecast it out on a monthly basis, it gets a little interesting. So I'd love to hear more about how you just work with the entrepreneur, because you guys do some forecasting and some planning ahead of time. And I'd like to hear more about that process.
Absolutely. So again, what makes us unique is that we target proactive meetings, right? And so I'm going to give you an example of 3 clients we're working on right now. All 3 have a liquidity event. So they had an exit with a business, some sort of business, whether it's real estate development, a business that they brought up and built themselves over time. So we have 3 that are having liquidity events, and they have tax exposure in the ranges of about 22 million, 45 million, and about 127 million, right? Now that one has a liquidity event of about a $400 million real estate development sale, right? Liquidity event. Now he's got $120 million tax exposure, right? So we're working with his team, and he's got about 70 different entities, but we're working with their team now proactively trying to figure out how to attack and mitigate legally and ethically parts of that income that's coming from that sale, right? And then slowly but surely on a proactive basis. So we meet with every client on a quarterly basis throughout the year, tracking their financial statements, right? We want to make sure that they're and for the seasonality ones, right, that flow in ebbs and lows, we want to make sure that we're tracking that revenue, not waiting to Q4. And it's like, oh, we have a big pop, we have all this money. What do we do, right? And now the problem with everybody coming at the tail end of that, which makes it much more efficient to do it from the beginning of the year throughout the year, right? Is that you have the holidays that come into order at the end of the year, right? So going back to these three clients with these very large tax bills, we're chipping away one strategy at a time, and we're knocking out 5 million of income, 15 million of income, 25 million of income, and even larger chunks, right, at the time throughout the year, so that we're not all crammed in at the last part of that year with the holidays, and then it becomes very stressful. There's a lot of room to make errors and mistakes, right? So when you plan out quarterly and throughout the entire year, you're smoothing out all the errors and mistakes, right? So you're really attacking the tax exposure up front throughout the year. Now, sometimes these liquidity events have earnouts that come out at different parts of the year, right? Sometimes they may not get all their money at once, but they'll get it in sections. And so that's what makes proper planning important.
Yeah, no, I love that. And, I think there's also something that you guys have done that I think is really, really good too. Because when I think about tax strategy, there's so many different opportunities out there from a tactical point of view. And aligning those tactics with the client's goals and objectives really starts to hit the strategy, bucket, right? And so I think about strategy, and oftentimes, and this is a frustration I have with CPAs, their strategy is go spend some money, go buy some more equipment, go buy a vehicle, prepay some expenses. And I'm not a huge fan. I'm okay with prepaying. I'm okay getting a deduction for things that I'm going to buy anyway. If I'm going to buy the thing, let's do it in December instead of January, so I can, sort of use that tax savings all year. But to just go out and buy a new piece of equipment because I need a write-off, I'm not a fan of spending $1 to save 37 cents. That math doesn't work out very well. So I see the way you're structured, because so many of the strategies that I think make sense for entrepreneurs is I invest $1, I get a deduction for that $1, and now that wealth can grow over time. So I see the fact that that's another problem that CPAs have.
Yeah. So let me dive in a little bit more on that, right? So that's where I get a little excited about. So you're correct. So typically the one thing that saddens me every single time is that when I hear a client state, my CPA told me to go out and buy an SUV of 6,000 pounds depreciated under bonus depreciation, right? So, and I think a lot of those, again, I'm not speaking for all CPAs, but I'm going to speak for the majority, is they're not securities licensed like I am, okay? Or like you are, right? So we know, and again, CPAs and financial advisors always butt heads. They don't like us being in their sandbox. We don't like them being in our sandbox. But prosperity tax advisors, I have a very big sandbox with everybody in it, right? And that's the important piece, because we're not just saying go buy something whether you need it or not, right? And just go get a deduction. For that matter, you might as well just pay the tax bill and just be done with it. But we have strategies proactively that will look that have more advanced operating efficiencies, such as, you know, an entrepreneur may be an S corporation or a pass through entity. There could be a way, right, from an advanced side to look at separating parts of that business. Maybe they have a marketing department. Maybe they have a vehicle transportation equipment department, right? We also look at the lens of separating multiple entities to also do what we call income shifting from one entity to another, right, to take more deductions in that entity there. But another thing we look at is asset protection, right? Entity optimization. And I know we'll come back to that in a second, to help you protect against inside liability risk, outside liability risk, and lateral liability risk. And I could go through those later.
Yeah, this could be good.
So, but yes, in essence, we have, again, each client has their own risk tolerance. So we're bringing the blend and flavor of both, you know, the private wealth side, the tax side for that client. Because if they're open to taking, and I don't want to say that if their risk tolerance is a little higher, and I'm going to give you an example like an oil and gas, right? So that is a typical go-to from a wealth side. Now, that's great. It does come with some elevated risk, like any investment, right? Guarantee on the risk side there and the return side. However, when you have an oil and gas, it's a wealth generating opportunity, but it does carry some risk that if that particular oil company is exploring for natural gas or oil and it hits and it has, let's say, one of the rigs have a fire, well, it's possible that damage and that lawsuit, if there is one, can extend and come into your scenario, right? That's the risk when I mean there. But just like anything you invest in the market, right? The markets go up, the markets go down. There's risk with investment there. But this gives you a tax deduction. But we have other strategies, more advanced, and dozens of them. And again, each client has their own custom sort of scenario, right, that we apply these strategies for. So it's really based on tax liability. So if they got $100,000 tax exposure, we have certain strategies we can attack that with. They got $1 million tax exposure. In other words, a check they got to cut to the IRS in that amount. We have a more elevated set of strategies. And then obviously when we're getting into the 20 to 30 and the $100 million tax exposure, these are what the high net worth people are using left and right to replace that check cut to the IRS and turn those dead dollars into wealth generating opportunities. Where we come in and help with some of that, a lot of that stuff.
Yeah, I love it. So I want to dig into this a little bit because I think you've got some really cool things going on. One of the things that we see with entrepreneurs oftentimes that come to us, they've outgrown their CPA. And what I mean by that is their CPA works with lots of folks that are, you know, W-2, they're doing okay. This might have been their dad's CPA. And so they're like, cool, we'll get started. And now they're to the point where the CPA just doesn't understand. You know, they're not keeping up with what's going on. They're missing quarterly payments. There's all sorts of things that are happening that are somewhat problematic. So if somebody's, because I think one of the things you do that's really cool, and I think this will lead us down a few different paths here, is you also help clients with the tax filing, right? Like if you can help design the strategy and then help execute on the tax filing. So can you talk a little bit about that side of the business and how?
Absolutely. Yeah. So I'm going to give you an example of a client who was about to leave their CPA, but they did a tax strategy with us with a depreciation style tax strategy, which we purchase a software or a movie film, right? And then so we take the depreciation onside that. Now, if we include in our services the compliance side of that, right? The tax prep and file side. But this client's like, listen, let me finish up with my existing CPA, and then next year I'll move everything to you guys. So we get that a lot in the beginning, right? Because again, CPA is one of the most trusted people, even if they don't know tax planning and are not proactive in communication, right? But they are one of the top 5 trusted people to an entrepreneur. So, and you and I are more towards the bottom of the top 10 as far as the trusted people from a wealth side, right?
Yeah.
So anyway, the individual client, so we did our tax strategy and we have our tax savings. And then we did the strategy and we provided the tax form to the client so that we already did our section, right? Well, their CPA filed it incorrectly on the state side. And so now this client literally just last week has a state notice stating that they're going to make an adjustment because that CPA incorrectly filed her return with our strategy.
Yep.
And so now she's got this state tax, which again, if we filed the return, we know better not to, because the particular state did not conform to the bonus depreciation or section 158K. So he should have knew that as a CPA in that state, but he didn't, right? And so that's the complexity and the confusion that happens. So we at first tell everybody, listen, to build that relationship with you, yes, we could do the tax strategy all day long and then provide that information to your CPA. We could even walk that situation through with your CPA. But a lot of times that CPA won't pick up the phone, right? I get it. It's a defensive mechanism from them. But in reality, look what happened. That client has now she's got to pay us from an audit resolution standpoint because now we got to take over and go question the state, right? So that's a perfect example why we do everything in-house. We do the strategies. They are very complex. They are a lot of moving parts. And who knows better to file that return? And if questioned randomly by the IRS, who knows better than to answer the IRS question, right?
Yeah. Yeah, this is great. And you're leading me right where I want to go with this conversation. So I think a lot of times when the general public hears tax strategy, they're like, ooh, this sounds scary. You're gonna lead me into some path and it's gonna trigger an audit. That's my favorite term, like trigger an audit. Like there's these things out there that like, yes, you can do foolish things like get the wrong numbers in the wrong place and the IRS is going to go, wait a minute, this is a problem. Let's go look at it. But there's no strategies out there when executed properly, are going to necessarily trigger an audit. So I think there's concern about, okay, man, what happens if the IRS shows up? Because this sounds scary. At the end of the day, the IRS is part of the government controls the military can come show up at my house and take all my property, right? That's the scary part. So
yes.
Talk to us about audit defense and how your firm handles that. Yes, I think this is good.
Great lead way in. So one thing we do differently for our services is we do the implementation, we do the documentation, we substantiate why the client is proving to receive the tax savings, the expenses, or the deductions, right? And one thing we do one step further is audit protection. Now, what does audit protection mean to your crowd? Well, audit protection means that my firm stands behind our tax strategies, regardless if questioned at any point by the IRS, right? And then how that process would work moving forward is we would have the client sign a power of attorney, no different than a traditional CPA firm doing the same thing. Except for we're not going to charge you audit resolution pricing, right? Hourly rates. What we do is we have a team of multiple law firms behind our firm that we bring in and we respond to the IRS for you. We do not pass any of those hourly wages to you. It can get as high as $1,500 an hour, right? Now, why do we do that? Well, we do that because I spend enough time doing the due diligence up front, having multiple law firms get their tax opinion analysis on the strategies, right? Now and I'm going to get to the strategies. Just remind me, Pat, that to get to social media and a lot of the talk on strategies out there, because I do want to spend at least 2 minutes on that.
Good.
But yeah, so we spend enough time up front doing the due diligence because I don't want to spend any more time with the IRS than I need to. But again, we back up our strategies 100%, meaning that, again, we'll take on that. And it happens a couple of times because, again, everybody can get randomly audited. There's not one thing that can trigger an audit. Now, I will tell you what the IRS is using. They got AI. They've been using AI since 2024 as part of their wide open scan. Now, what are they scanning for? They're scanning for misalignment in numbers. So
Mm-hmm.
you get a K1 for $1,000 and you have that same K1 for $600. You're reporting, there's two different reporting numbers. That's
Mm-hmm.
what the AI scans immediately and says, oh, well, there's a flag here. Now, that flag comes, right? Then they're going to start asking questions, and then they're going to start poking around. And so that's the important piece of having the right firm, not rush anything,
Mm-hmm.
right? Making sure you take the extensions, and you're allowed to take the extension. It's legally allowed up to 6 months. Whether you owe or not. Now, if you still owe a tax bill, you're gonna owe that same tax bill, right? But what happens is that you make sure that all your documents are in order.
Mm-hmm.
And there's no mistakes or errors. You don't want to rush into that, because again, that can open up more questions, and then it can open up a full-blown audit.
Yeah.
So
yeah, I love this. This is so good. And I think there's a few things. Like, we encourage every single client to extend. Even if you have everything ready to go, the data supports the IRS audits more on-time filers than they do extensions. So, like, just from that fact alone, I should extend and file the next day if I'm ready. The second piece is most of our entrepreneurs are involved in a lot of stuff.
Mhm.
And so they're waiting for all their K1s to show up. And it's like those K1s have, unfortunately, until the entity filing deadline to sort of get it all together. Now, hopefully, they're done well before that, especially, when you have entities sort of layered on top of each other. It's like that can get really messy. So, it puts all sorts of time pressure on the on the filing firm to get it all done. But I think extensions make a ton of sense for all the reasons you just said. It gives you time to get it right. It gives you less likelihood of audit. I think that that is all fantastic. So I you bring up social media. I love social media, because we'll have clients send us a TikTok, an Instagram reel, or something that's like, and we see these things and we're like, there might be a kernel of truth in there, but if you execute on that thing the way that guy outlined it, it's going to be a problem. So can you talk through social media for us?
So I love the setup here, man. This is too easy. So no, you're absolutely right. I heard last week, and now listen, I track all our competitors. I'm in the same communities as all our competitors, right? So I know a lot of them, and nobody has the firm setup like I do, with wealth, business, and tax kind of combined into one, right? So for the advice and for the tax planning sessions moving forward, right? So with that in mind, I heard a gentleman, I'm not going to obviously name their names, have a social media TikTok post or Instagram post, one of the two. And here's what they said. Listen, you can, he's walking and he's got the camera on him, right? Live thing there. And then he's like, you could go purchase, a short-term rental property, and bonus depreciate the entire property. So let me say that again. He said you could go get a short-term rental. Now, and I'll tell you the difference between short-term rental and long-term rental, right? There is a difference between the two, but
this is great.
Go get a short-term rental, and then you bonus depreciate, do a cost seg analysis, and you can depreciate the entire property.
Yeah.
That's incorrect.
Yeah. This is great. Can we slow this down for a second? Because I think this would be really, really good for people listening. So let's start off with a short-term rental versus a long-term rental.
Okay.
If we define a short-term rental, I'm going to do my best job at this, but the average daily or the average rental is 7 days or less. Is that correct?
Correct.
Okay. So if I've got a short-term rental, that's considered, and I'm managing that, it's considered active participation, right? Is that
considered a trade or business per the IRS? And so, in very simple terms, they treat that short-term rental as a hotel. So that's how you get the active side of that. Now, there's a few other parts that have to happen, right? So you still have to participate 50 more than any other person in that entity, one. And two, you still have to participate 100 hours a year. Now, it's not 500, it's not 750 hours like a real estate professional status, right? So it brings down a lot of the temperature requirements that you need. And then you could do a cost seg analysis, depreciate the property correctly. Then that big qualified business loss can transfer over and offset other income and other W-2 income as well.
I love it. Okay, so now I want to continue on this discussion on the comment that you can write off the, I'm going to call it the 100% of the purchase price. Okay, so if I buy a piece of property, and let's assume it's a standalone house that I've put on Airbnb, and let's say it's $1 million property to keep the math simple.
Sure.
Actually, let's make it 1.1. Okay, and the land is worth 100K, and the building's worth $1 million.
Okay.
So can I write off all 1.1 million? No.
And and I'll explain that, right?
Yep.
And that's what this individual said in their TikTok, Instagram session, right? So typically the process, when you look at depreciation, there are multiple depreciation methods, right? And what the purpose of using what's called a cost seg analysis is that it accelerates the depreciation from 27, 28 years, or if it's commercial property, it's over 30 years, down into the 1, 3, 5, 7 year time maturity, right? And what that does is that it accelerates the depreciation.
Yep.
Where the bonus depreciation comes in is some additional renovations or repairs to the property that you can, you look at appliances, HVAC, roof, right? So there are additional repairs, renovations that you may have in that property that you could get a bonus depreciation deduction added on top, which raises your qualified business losses, right?
Yep.
Now, with that cost seg in line, now there are different cost seg analysis companies, but they range from anywhere from 14 to 15% of the purchase price minus land, like a cabin, for instance. And then it could get a little higher into the 20 to 25% range of the purchase price minus land. Is that 100% of the purchase price? No, right?
No.
So I don't know where this individual gets their information from, but they are doing a lot of sessions on social media and incorrect. So it's very important you work with a subject matter expertise firm, because what makes us different also from a strategy to strategy session is how the implementation is done correctly. I'll give you one extra example if I may.
Sure. Yeah. Well, can we stop 1 second? Because I think one thing you highlighted, and I just want to put a dollar figure to it. Yeah. So if I've got $1 million property that I can write off 25%, I get a cost seg for 25% of that building that I can accelerate the depreciation. That means I can write off $250,000 off of my earned income if I'm participating in all the rules that you set out. So that's still a fantastic deduction.
That is wonderful, right?
Yep.
That is wonderful. But another thing to add on top of that is, obviously you got to look at what goes into that property, right? You got to put a down payment, you got to go through underwriting, get a mortgage, right? And all of that. We have some very sophisticated strategies that can do 3, 5, 8 times that deduction limit, right? If needed. This is how we can get into the upper 10s and 20s and hundreds of millions of dollars of tax exposure that we can mitigate pretty much close to zero, right? If done proficiently, depending on the client and their situation.
Yeah, thank you. Because I think there's a very, very important thing that you mentioned there. I see very much the same TikTok, Instagram that you're talking about, these people talking about. And what they don't realize is owning real estate is another business, right? Like you have to have active participation. You've got to be involved. You got to have that 100 hours involved. And so that's not like buying Amazon stock, right? No. Amazon stock, I can buy it, forget about it, come back and go, oh, it's worth more than I paid for it. Right. If I do that with my real estate, I don't get the tax deduction. The thing will be worth nothing because the tenants and nature will just consume the thing. So I love real estate. We're involved in hundreds of millions of dollars of real estate projects, and we love that. But you have to have the infrastructure to make it work. And if you don't, it's the reason the average landlord lasts 3 years before they're out. So that's right. This is great. Before we get back into the episode, I want to take a quick second to share something with you. If you're listening to this episode right now, chances are you're the kind of entrepreneur who wants to do more than just make more money. You want to keep more of it, grow it, and build real long-term wealth the right way. And the truth is, most business owners are missing opportunities every single year simply because they don't have the right strategies or tools in front of them at the right time. That's exactly why we've built the Vital Wealth Resource Vault. Inside, you'll find powerful tools, guides, and trainings designed to help you minimize your taxes, increase your cash flow, and start building wealth with more clarity and confidence. So if you want to take what we're talking about in this episode and actually put it into action. Go check it out right now at vitalwealth.com/resources. That's vitalwealth.com/resources. All right, let's jump back in with Michael Moffa. I'm like super excited about the strategies that you're talking about that are, I'll say, more passive, don't require my active involvement.
So a lot of the strategies we have are on the active side and the passive side. So we have a blend of both, right? Now, the reason for the active side is, and yes, the client has to be active in those entities, those businesses. It's not like we're creating a shell company and you don't have to do anything. No, there is some time that needs to put in. But if you think about it, if Pat, if I were to put it to you this way and say, listen, if you could save, and I'm just gonna throw a number there. Let's say we could deduct $1 million of income, okay? But one of a few different requirements needed is for you to spend 2 hours a weekend into that strategy. Would you do that? And that equals out basically 100 hours for the year, right? Could you do that to remove $1 million of your earned income, W-2 or 1099, right? Which can equate to a very large tax savings.
Yep.
Right? Would you put in that 2 hours a weekend?
That's a lot of money. That's a really good rate of return on my time if I can put that in. So I'm probably going to find a way to get that done.
Right. And 99% of our clients do, right? Again, IRS, we're not, there are a lot of requirements. There are a lot of restrictions, right? There's a lot of fluff out there too. So that's where we're working with the right team and the right firm. And I'm continue to build this firm of about 11 plus employees with the right designations and skill sets that you won't find in a traditional CPA firm, right? Because we want to make sure we cover every aspect of the industry for that entrepreneur or high wage W-2 that needs that tax advice and that tax planning.
I love it. Yeah, this is
if you don't mind, we should get to the entity optimization, because I say that's one of my favorite spots, right?
Yeah, and I think this is one of the areas that we see consistently screwed up, because there's not somebody. We have sort of two competing camps here, okay? And I'm going to highlight some of these, and then you can clean up my mess if that's all right. So on one side we have an asset protection structure, and so I am protecting my assets with LLCs. Legal counsel will say, "Yep, put every entity in every business or every property in its own LLC. It'll segregate the risk, and you'll be in pretty good shape." And then on the other side, we see some of the tax moves. And like, for example, we had a client came to us with 4 S corps that all kind of work together, and I'm like, "You got to take a wage out of all these. What the heck are we doing?" So. So like there was some cleanup there. We were able to sort of restructure that under like one S corp, and we had Q subs in place, and without getting all
Q subs,
nerdy there. But it's like, okay, people hear this cool tax strategy, like, yes, I need an S corp, and then they go just like start applying S corps to everything. It's like, slow down, stop doing that. Right. Then there's like things like a C corp. Like C corps look pretty cool because I only pay, a 21% tax rate versus 37% tax rate. But if I want to try to get the money out of that thing, it's locked up forever. So, I think there's all sorts of different things we can look at. And I love your entity structure, because I think there's some asset protection things in here that most people are going to miss. And I'm excited to hear you talk about it.
Yeah. So a lot of times, again, over the 25 years of my experience, and this is what again makes us very unique with our firm, is more of the entity optimization side. So what people tend to so let's go on your example with 4 S corps, right? How do you define an S corp to begin with, right? How do you know to file for an S corporation versus an LLC versus a C corp, right? So that will just determine on the client and their scenario, of course, right? Because you have a sole proprietorship, which we have seen some clients start with that, and as far as risk protection, you're completely naked with that, right? Yep. There's no protection, both internal and external protection. So when I say external liability risk, right, what I'm meaning is that the accidents, right? You get into an accident, texting, driving, DUI, night driving, right? So any sort of accident there, a civil suit, it could be a slip and fall, it could be anything external out of your business in the personal life, right? All of that can be affecting you individually. So what lawyers have been very keen on and very, very smart over the last 10 years is they don't only sue you and your insurances anymore. They're going to sue the insurances, whether you have an umbrella policy, auto policy, homeowner's policy, short-term renter policy, and then there's you civilly. They will always bring you in civilly, right? Because now they know they can get paid by the insurances, right? But now they come after you civilly. Now you got to hire an attorney to defend yourself civilly. That is outside liability risk. How do you protect that? Well, you got to form sort of a structured hierarchy as far as all the assets and operating companies, divide them up between what is passive assets, what is operating companies. Now, they should all flow down in a hierarchy into what we call a holding company. You should have a holding company in the operation side that holds all of your operating companies, right? The companies that you're active in, and the reason for that is that you remove your personal name from those entities. Let me give you an example of somebody that let's just say let's bring you in, right?
Sure.
You own ABC LLC, right, Pat?
Yep.
Now, if there's a outside liability suit, somebody slipped and fell at your house, you were having a party and somebody slipped and fall, pretty damaging, and they come after you. They sue you civilly as well as your homeowners and everything else, right?
Yep.
Now because you own ABC LLC in your name, they can come after, depending on the litigation, deposition, and the final result. If they win that lawsuit, they can come after the ownership of your entity, your business. They come in. They are now a partner in that business with you, right? And so how do you keep them out is by structuring layers of other entities in place. Now, at the bottom layer, what we typically like to see is a revocable trust. Now, a revocable trust is not asset protection. Why? Because you are the grantor and the trustee of that trust. But it takes them a couple of minutes to figure out who owns that trust. Right? Then that trust owns the next layer up, which will be the holding companies, either on the operation side or the passive asset side. And then from there, that holding company owns your operations, and that holding company owns the passive assets. It could be real estate, it could be your individual brokerage account, it could be your crypto account. Right? And on the passive side, let me just speak just 30 seconds on that. That holding company we typically do in Wyoming. Now, there are about 8 states that we do asset protection entity creation in, right? There's Nevada, there's Arizona, there's Alaska, there's South Dakota, right? There's Wyoming, there's Delaware, there's North Carolina, right? So there are states that have different statutory protections, but also the state that the client lives in, whether that law, that jury there can conform to some of the outside asset protection entities, right? Like Florida, for instance, doesn't recognize what we call DAPs, right? Domestic Asset Protection Trust. There are 18 states that do that. What is a domestic asset protection trust? It is a combination, a hybrid of a little bit of a revocable trust and mostly irrevocable trust. Now, what do I mean by that? Because you could be in there as the beneficiary, right? And typically a irrevocable trust is an asset protection entity against creditors, right? So now I get deep into this, but anyway, there are so many different trusts. There's about 12 different trusts variations you could start your foundation with. Then those trusts need to own holding companies.
I love this. So I'm going to recap a few things, and then I've got a few questions for you. So I think about the inside protection, and I'm going to, if I've got a rental property, it's a short-term rental like we were talking about. There's somebody throwing a party. They have a few too many drinks on the front porch, and they fall off the front porch and get injured, right? Like that's going to protect, if I've got that asset in that LLC and I get sued, they can't come after my other assets because they're owned by different entities, right? They're going to.
But they could if it's negligence, criminal, or fraud.
Okay.
If you forgot to fix something that they slipped on, that's negligence, right? That can pierce the veil of that protection LLC.
I love it. So in that case, now we're talking about like, if I'm negligent, if I'm driving my car and I run into a school bus full of lawyers, kids, and then they start to sue me, Now me individually and everything I own, which would be all those LLCs, is at risk, right? So I've got to create a layer of protection there that protects me from the stupid things that
Right.
I do. So that's really good. Okay, so I want to highlight something you said about the trust, because
Okay.
I think let's role play a conversation that happens. If let's pretend you've got a no trust structure. Okay, you just own everything in your personal name, and I come in and um, somebody gets hurt, and they come into my office as an attorney, and they say, "Hey, Pat, I want to sue Michael because I got hurt." And I'm like, "Yeah, sure. Just give me a minute." And I get on my computer and I search Michael Moffa, and I'm like, "Oh, cool. I see Michael owns like 17 LLCs. He's got a very successful business. I would love to take this case. It will just do it on a contingency. A third of whatever we make is
Mhm.
what we get paid. And if we don't make anything, we don't get paid anything." Right now that lawsuit started and they're excited. If I do that same search and I don't find your name anywhere, I'm like, I would love to take this case. I just need a $20,000 retainer. You know, now that conversation is different. That person's going, I don't have $20,000, right? Like I'm broke. I'm like the rest of America. I don't have any money.
Right.
So that lawsuit can go away because there's not the same clarity into the things that you own, because all I see when I search your name is, nothing, right? Like your personal residence is in a trust. Like I can't find anything on you, no vehicles, no nothing. It's like, well, geez, this is going to be tricky. So I think that's a key distinction there. I don't know if you have anything to add to that, but I think that's
I
a
do.
nice thing.
So you are correct, right? So it does make an instant judgment from the legal side that if they quickly do a search on social security number and then try and find you, if you own entities in your name, you're easily found and you have assets, right? And then that's where they start the deposition, move through the deposition into well, what assets, liabilities you have. And then keep pushing through that and then go into the litigation, right?
Hmm.
And then obviously a final thought on that at the end. So one way to protect and create a wall. So that first layer, that foundation, which is usually a revocable trust. Again, keep in mind it's not
Hmm.
asset protection, but why
Right.
is that revocable trust there to begin with? One, if you name that trust in a different name, not your last name,
Yep.
family revocable trust, right? Which I see a
Hmm.
lot of,
Yep.
but ABC Land Trust or ABC2 Trust, whatever the
Hmm.
name is outside of your last name, it's going to take them a minute to figure out if that's you, right? It's like, well,
Hmm.
this is a trust. They don't know what kind of trust it is, right? And there are the trust that protects against creditors and litigators are the irrevocable trusts, right? That's where the DAPT comes in, the Domestic
Yep.
Asset Protection Trust primarily. So that helps you just in the beginning to buy yourself a little time. But then when they do a little more deeper research, that requires the retainer, right? Now they do a little more research. Oh, well, it is Michael Moffa, right? Michael
Hmm.
owns that trust. Okay. So what does the trust own then thereafter, right? If our holding companies we create on the passive asset side, Pat, when I say passive
Hmm.
assets, it's real estate, commercial property, short-term rentals, long-term rentals, brokerage accounts, investment
Yep.
accounts, crypto accounts, all of that is passive assets, right?
Hmm.
We create a Wyoming holding company with a mechanism called COPE, a COPE. That
Yep.
stands for Charging Order Protection Entity.
Yep.
You're going to love this. So what does that mean and why is that beneficial to a client to layer in that holding company in Wyoming? Well, I'll tell you two reasons. One, what the state of Wyoming has what's called a privacy statute. You will never, other than the IRS, you will never find who owns that, what business or what
Hmm.
entity in the state of Wyoming. You have that privacy protection. Number two, that COPE mechanism, it's the charging order protection entity. It is legal language written in the operating agreement of that holding company. What does that stand for and what does that mean? It stands for that if they were to penetrate through the revocable trust, or let's say you didn't even have a trust in the
Hmm.
foundation layer, you move right up to that holding company, right? What happens is that they can only go after the charge. They have to come after you with a charging order first. If they do
Hmm.
not, lawsuits dropped. So then they could obviously amend it and refile the litigation suit with the charging order language in it. Okay, let's say that moves forward. Now they come after you with a charging order. Pat, do you know what all they can get from that wall, that holding wall in Wyoming? The only thing they could get, only thing, is the distributions you take from that holding company's bank account to you personally. So let's just say round number, it's $50,000. You collect $50,000 of income from your brokerage account, your crypto account, your rental account. They all flow into that holding company's bank account. That is what the creditors can only come after, is the $50,000 of income. Now, if you don't take that distribution and you do not take that withdrawal, leave that money in that bank account, they can't come after anything. They can't force it.
Yeah.
Because again, it's legal language written in, that's the secret sauce in the operating agreement.
Yep.
It creates a second layer of deterrent, and they will get what's called phantom income tax. So they will be taxed, the creditors, on that 50K, even if they haven't received one penny of it, right? It is amazing. That will almost immediately, from what we've seen in the very few cases that happened in, lawsuits are dropped. Why?
Yep.
Because that creditor is not going to pay tax on 50K of income when they haven't received $1 from you, right? What's the point, right? They can wait, you can hold out.
Yeah.
And then once that lawsuit is dropped, wait a couple of months, and then you can obviously take that withdrawal from that bank account to your personal bank account. But again, they never go after the assets behind that Wyoming holding company. Fire sale, force anything, nothing.
Yeah.
So it's very important to have that. And a lot of people are not aware of that.
Yeah, I love it. Now, I'm wondering if you have thoughts on, because sometimes we see people really fired up about their asset protection and they don't, I'm looking around, I'm like, you need to go build more wealth, you know? Is there a level like that these things need to happen sort of as your wealth continues to grow? Is there sort of like phases to this thing? I don't know if you have any thoughts or comments on that.
Sure. Yeah. I mean, I would always start, you got to start with the foundation. So a lot of people don't have a revocable trust. And again, why do I say having that? If you got a family, and the reason why that's the foundation that should own your assets is because if something happened to you prematurely, you know this, right? You have estate tax and you got to go to probate.
Yep.
If let's say a spouse or both pass away. So the revocable trust is there to effectively, disperse your wishes, right? In the trust. If you have kids, the beneficiaries, maybe you have legal language about age, disperse the money, whatever the case may be, but you avoid probate and then you already have it in place to segregate your assets to your beneficiaries, right? So that's why that should always be the bottom line. Now, there are 11 or 12 different types of trusts, right? And we could obviously, each client is different based on their circumstances and complexity, but yes, you should start with the layer of revocable trust first and then go with the holding company. So let's say you don't have real estate. Yep. You have and some states protect the IRAs and the Roth IRAs from ERISA, right? So you have regulatory bodies that protect those accounts, but there are some states that the IRAs are vulnerable to from a state side. So you got to watch too what state that you're in and if your retirement vehicles are protected or not. But if you don't have real estate yet, but you have a brokerage account of $500,000 or larger, I think that's a good point, in my opinion, on that.
Sure.
Good point to start. Get it out of your name.
Yep.
Or worst case scenario, make sure you don't have joint with rights of survivorship. Look at tenants by entirety is another way to look at it, because now some states look at that differently. So again, it's on a state-by-state pleasure. But when you look at tenants by entirety, you're splitting that account in half, 50-50. So you're in a car accident and then your spouse is not with you, they can only come after that 50% of the account. But if that combined account is a joint with rights of survivorship, you're in the car accident, your wife is not with you, well, now they come after that entire account.
Sure.
Right? So tenants by entirety is usually the first level. And then again, the holding company in Wyoming should be created and then build your LLCs on top of that. Let me tell you why accountants don't do that, or at least they're shy against that.
Yeah.
Because of the filing status, right? So the accounts, the CPAs have to charge you for that tax form, that Schedule C, right? It's an entity, it's a business. So they got to file that form. So that could be another couple $100, right? And then you got to file the annual minutes and reporting every year. That could be a couple $100 there. If you have a registered agent, you got to pay for that. That could be another $100. So what the traditional CPA firms do is they tend to talk out the clients in protecting their assets, because one, they don't have the knowledge and the skill set in the asset protection realm or the entity optimization realm like we do. Two, they scare the client like, oh, you got to pay, $600, $700, $800 for just these entities, just to file them and their tax return, and then of course the annual minutes for the entity itself in the state. But is it worth $500-600 a year, $800, I don't know what the number is, depending on how many entities. Is it worth the protection of your assets that nobody can penalize? As long as you follow no negligence, no criminal, no fraud, everything is protected. Personal assets are protected from business claims, inside the business claims. And the way you structure the entities layered, like I mentioned before, you protect against outside liability claims.
Yeah.
So to me, it's worth spending that money.
Yep.
And if high net worth people and entrepreneurs have wealth over time, you work your life to build this wealth. Why not spend a little bit? And it's tax deductible, by the way.
Totally. Yep.
And protect your assets.
Yeah. It's a very, very inexpensive insurance, is the way I look at it. So,
speaking of insurance, sorry to cut you off, but this is super important for the ones that don't have the setup like I mentioned. Obviously, they can chat with us at any point in time. We can have conversations about entity optimization. But there's one thing I want to point out that people keep forgetting and don't know. So let's say you have, Pat, I'm going to use you as the example. You have an LLC, ABC LLC. You have a rental property. You own that rental, that LLC in your name. Okay. So as long as you didn't commit fraud, negligence, or anything criminal, you protect your personal assets from a short-term rental slipping and falling on the property and suing you, right? Now, here's one thing that people forget to cover as far as liability insurance. So there's something called D&O liability insurance. It's directors and officers liability. Why do you need that on top of a short-term rental policy or anything else? Because you're the managing member of that entity. You're an officer of that entity. They can sue the entity and they can sue you as the officer. Now, again, you're going to civil court or federal court, depending where they take it. Now you got to bring personal assets in to help fund your defense. So if you own anything right now in your individual name of an LLC, S Corp, C Corp, it doesn't matter what it is. You need to make sure with your property and casualty team is to look for directors and officers liability policy to protect you. Now, if you have another entity that is the managing member of that entity, you don't need that, right? Because you have another entity in protection, you're layering down. So that's something that I think would be a great tip for your base to look at. If you own an LLC in your name and you just haven't had the time yet to structure how I mentioned it earlier in the different layers, at least look for directors and officers as additional protection on top of whatever general liability you have. Very, very important.
I love this. Michael, we need to wrap up. Otherwise, we will talk for days and people will be like, when is this thing going to end? But I think this has been fantastic. Sarah on your team's incredible. I think one of the things that people should do is just get plugged in. They should reach out. When I go to prosperityta.taxadvisors.com, so prosperityta.com, you can book your intro call. I think that's a great place for people to go. They can also look at some case studies and just get overview of who you guys are and how you think. But I look at the work you do on the tax strategy, and it's incredible for entrepreneurs that need planning, that are looking for new CPAs. You guys bring the whole structure, and also just the conversation we had about entity structure as well. It's like it's the total package. It's really good. And I think I'm a fan of Dan Sullivan and Strategic Coach, and he says, don't learn how to do things. Go find a who to help you, right? Like, get an expert in your life to just take care of the things that you're not good at, and you just stay in your lane and lean into your unique ability. And I look at the work you guys are doing, and you take so many things off the entrepreneur's plate that just allow them to sort of just pay less tax, protect their wealth, build for the future. I think it's great. So is there anything else that people should be doing to connect with your firm that I didn't mention?
No, that's it. You can reach out to Prosperity Tax Advisors, and that would be the best way to contact us. We're here in Tampa, Florida, but we service clients across the 50 states. So most of our clients are in more of the blue states that are more triple taxed, right? Federal, state, and local. I mean, there's some states that get up to 55% of your money in tax between all the different layers. So that would be the best way to reach out to us. Take a look at our TikToks and our Instagram. Do them as well correctly. And if you guys have any questions, you can always email me at mmoffa. That's MMOF as in Frank, F as in Frank, A at prosperityta.com. And we're more than happy to have a conversation discussion with you and see how we can help.
I love it. We'll make sure we have links to all of that in the show notes so people can find you quickly and easily, because this is the time, right? Like, do not wait until October, November, December to solve your tax problem. This is the time to start the planning. You have plenty of runway to get things going for 2026. If you're frustrated by 2025's tax bill, right now is the time to get these things going. So thank you, Michael, for joining us here today. We'll have to do this again, because I think there's probably 4 or 5 more topics we could talk about.
Absolutely, man. And I appreciate the opportunity. So
yeah, this has been wonderful. Thanks, brother. All right, that's going to wrap up today's episode of the Vital Wealth Strategies podcast. First off, thank you so much for tuning in. I hope you found a ton of value in this conversation, and more importantly, that you walked away with something you can actually apply to your business and your wealth strategy right away. If this episode helped you, do me a quick favor and share it with someone who you know that could use this information. Another entrepreneur, business owner, or high-income earner who's working hard but may not be thinking proactively about taxes and long-term wealth building. And if you want to dive even deeper into strategies like we discussed today, make sure you check out vitalwealth.com/resources. That's vitalwealth.com/resources, where we've built a vault of resources designed to help you minimize taxes, build wealth, and take control of your financial future. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here. I'll see you next week, right here on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.